Hey everyone, glad to be with you today. It's a beautiful and hot day in Oklahoma City. Don't know where you're watching from, but we've been dealing with some days over 100. So I hope it's cooler where you are. I'm Jake Weatherford. This is Adam Lee. As always, we're glad to be here with you today. Today we're going to talk a little bit about how much money do you need to retire. What we've found is that even some of our wealthiest clients, younger clients, older clients, they don't know how much they actually need to retire. So for us, that's kind of like, if you don't have a goal, you have no idea where you're going and you don't know how to get there. So we're going to talk a little bit about that. We're going to talk about two different situations, made up situations. Stress that these are completely made up, completely new information, new clients. There's nothing real about these scenarios, but there'll be two great examples for you to just get an idea of kind of what you need to retire if you want to spend a certain amount of money, and how you can simply calculate it on your own. That's kind of what we're going for today. Keep things simple, give you some tools that you can use on your own if you wish. So anything from you before we start, Adam?
No, I think you covered it. Let's get into it.
Okay. So step one, we always have our disclosures. Again, these are all made up scenarios. Nothing about this is real. So there's a disclosure there. And there'll be disclosures on some of the slides we go through as well. So some of the things that we want to talk about today are a simple rule. We call it the 4% rule. So this is again, like I always like to stress, this is not a super accurate rule. There are much better ways you can calculate these things. That's why we have jobs, because we calculate these things for people. But a simple way that you can calculate this, right, Adam, is you can say, okay, if I want to spend $150,000 a year in retirement, I can divide that by 0.04. We call it the 4% rule. Mm-hmm. That gets you to a number. So let's just do that calculation. 150,000 divided by 0.04 gets us to $3,750,000. Okay, that's a decent starting place to know how much I need to fund my lifestyle when I retire. Right? Mm-hmm. It's definitely not a hard and fast rule. There's different things that feed into this. What does that ignore? Completely ignores any compounding interest. Mm-hmm. The last video I did was on that topic. It was all about why compounding interest is important. So our 4% rule completely ignores that. All it tells us, and so by ignoring that, it basically makes us save more money to get there, right? So if I had 10 years to retirement and I was planning on doing this 4% rule to spend $150,000 a year, I'd have to save $375,000 annually, right? Mm-hmm. $3,750,000 divided by 10, have to save $375,000 a year. If I divided that by 30, if I started when I was 30 and I wanted to retire when I was 30, so let's take that $3,750,000 divide by 30, I get to $125,000 in savings every year. Now, I don't know about you, but I can't save $375,000 a year. I can't even save $125,000 a year. Some people certainly can, but you don't have to, and that's kind of the point of my part of this webinar. So we're going to dive into some scenarios, dive deep into kind of what it looks like when you do have that compounding. We'll go through a couple different portfolios and talk about why the numbers are different than these. But before we do, anything to add there?
No, I don't think so. I think, just the 4% rule, the origin of it was basically somebody ran some historical numbers and said, hey, if you took this from your portfolio, in no case, within that data set would you ever run out of money. And I think the really important point that you're making is, if you just use that 4% rule, first, it doesn't include things like Social Security,
exactly.
What's actually in your portfolio. Obviously, we think that's important. But to that point, if you just take, that number divided by 0.04, and you say, oh, I have to save this amount of money. That completely ignores the whole point of investing, right? We're investing so we can speed up your path to that. So I think it's just really important. Great starting point. But yeah, lots more detail that needs to be filled out.
Absolutely. So I'm switching my screen here, so excuse my reach. But let's start with someone that is 50 years old. So that would be in my scenario, I did $3,750,000 divided by 10. You have to save $375,000 annually. So let's say we are 50 years old, and in this scenario, let's just say we have $0 in savings, okay? So you've got 10 years to get there. You are going to have to save a lot. And the reason we're starting with someone that's 50 is that we do have some folks that come in here. It's rare that they have $0 in savings. Sometimes they do. But more often than not, they do have some type of start, but they still feel like, and we hear a lot, oh, I'm 50 years old, I'm behind. I feel like I'm behind. I got to catch up to where I can actually retire and maintain my lifestyle. And so this is not, this is a made up scenario, but it's not uncommon for someone to feel that way. And really, there's two things. One, maybe you are a little bit behind, so what can you do about that? You can do two things. You can catch up, you can heavily save, or you may have to lower your lifestyle. Again, I want to highlight something you said. Even in these scenarios, we're completely ignoring Social Security.
Yeah.
You and I have done a long bit on why maybe we shouldn't ignore Social Security. We do think it will be there for people. But at the same time, one of the things that we hear is, hey, I don't want to count on it. If I get Social Security, great, but I don't want to count on it. So going back to our example, we start with 0. We want to get to where we can maintain our lifestyle throughout retirement. We want to spend $150,000 a year. Okay. So what do we have to save? We don't have to save $375,000. In this scenario, you would have to save about $300,000 annually in an 80% stock, 20% bond portfolio. What is that number if you would like to do a 100% stock portfolio? That number goes down, and I am looking, that number goes down to about $250,000 a year. So why is that? Why does that number go down? Well, if I increase my stock exposure, I should have a greater expected return. My deviation, my up and down in my portfolio will also be greater, but I should have a greater return over a long enough period of time. This is not a recommendation. We're not recommending anyone do this. It's very individualized based on your unique situation and things of that nature. But that's a common theme that we see is okay, if we increase the stock exposure, we obviously have to save a little less because we're making a little more. Right?
Yeah, and an important point on that too is something that's kind of a rule of thumb that we also will get into, so kind of a sneak peek for later, is hey, sure, if I increase my stock allocation, I'll get to my goal faster, but there's maybe more risk. There's more chance that the stock market crashes and I run out of money. And there are situations in which that is true, that maybe you could still hit your goal on average and lower kind of the downside risk by allocating more to bonds, but it's not always true. And that's an important other reason why, this allocation thing we talk about is really important. It's really important to have a plan, talk about goals, talk about risk preferences and things like that, because there is no one size fits all solution. It's not always just, hey, go to 100% stocks because that's always going to increase expected returns, and it's not go to 100% bonds because that's going to increase safety. There's a balance there.
Absolutely. So that's good, Adam. So let's talk a little bit about the 30-year-old, and then I kind of want to get away from the unique scenarios and talk more generally about what this really means for anyone that's watching this video. But for someone that's 30, so now let's go all the way back to where we started, the 4% rule, right? So we got to that $3,750,000 is what I need to spend, roughly is what I need to spend that $150,000 annually in retirement. Again, that ignores all compounding. So when we take a 30-year-old and we say, okay, you have 30 years to retirement, obviously we have a lot more compounding, right? So on this one, we're going to start with a 100% stock portfolio. Why? Because this 30-year-old has a long way until he or she retires. So let's start there. Again, not a recommendation. That's not even true for all 30-year-olds, but it's a pretty good general rule that the longer you have, the more in stock exposure you can handle. So again, depending on individual, factors. But for this person, we see the savings number drop a lot. Why? Because, we have 20 more years to save and to compound. So with this person with 100% stocks, all they have to save, I shouldn't say all, and shouldn't say all at all because that is one of the points that I'm going to get into right after this. But for this person to get to that number that allows them to spend $150,000 annually, again, that is adjusted by inflation, which is also very important, and what the 4% rule can ignore. You're going to get into that more later. But this person needs to save about $45,000 annually to get to a point where, and another thing that I want to highlight is that's to get to a point where you're not spending down the portfolio. So you don't technically have to save that much money to spend $150,000 in retirement, but you have to save $45,000 annually if you're 30 years old in a 100% stock portfolio to get to where you don't spend down your portfolio in retirement. And frankly, sometimes that's not the goal, right? I'm going to go to the line graph here, Adam. But sometimes that's not the goal. The goal sometimes is, hey, I want my last check to bounce. We've heard that before. But typically, people that are planning this far out want to maintain their principles. So that's why we plan for that. So, what does that tell me? Well, $45,000, and this is kind of what I alluded to. $45,000 is actually is more than you can save even if you're maxing out a 401k. It's about 5-8 times more than you can save in an IRA, an individual. So that's another important aspect to this that often gets overlooked is, where do I save the money? So if you're saving in a 401k, you can save 22.5 is the max. So that gets you about halfway home. If you're married and your spouse has access to a 401k, there you go. You're at your 45 number. Now, if you either are not married or your spouse doesn't have a 401k, and this all assumes the individual has a 401k, and maybe we can talk about if they don't. But if you have a 401k and your spouse doesn't, what you can do is you can max out your 401k. You can max out an IRA for both spouses, subject to some limitations on income. Or the third option is, and it's also an important option for people that want to retire before 59 and a half, is just saving after-tax dollars, saving in a brokerage account and getting it all invested. Again, our example only works because we have compounding interest. We're assuming that your savings is invested, which is very important. If it's not invested, you're going to have to save a lot more.
Yeah.
So I'm going to pause there and just highlight a couple things. One, $45,000 annually, compounded at a 9% return. That's the 100% stock portfolio return that we're assuming. And where is it saved? Well, if you're married and you both have 401ks, max out both the 401ks. If you're not married or one of you doesn't have access, max out one 401k, do the rest in a combination of IRAs and brokerage accounts. And then let's hit the scenario where nobody has a 401k. Okay? If you can save in an IRA, do that. If you have your own business, check out starting a retirement plan for that. If you have none of those options, save in a brokerage account after you do everything you can tax deferred. That's important to do as well. Again, for those people that are retiring early and they want access to those funds before 59 and a half, trust account, brokerage account, individual account, joint account. We can talk about the nuance there in a different video, but those are great places to save. So
Absolutely.
That's a lot. Go ahead.
No, I don't think I have anything to add to that. I mean, that's perfect. There's a lot of options out there. And that's the role of an advisor too, is to, when it gets complicated, to say, hey, these are all the different options I have out in front of me. And, depending on your circumstances, we can force rank. Like, you didn't get into this. I know we could get in another video probably, but things like, do I have access to a Roth IRA? And if so, should I invest in that before a 401k? Or what if I only have a Roth IRA? Should I do that before a brokerage? And, there's general rules out there, sort of like the 4% rule, but it's great to have, somebody to help kind of guide you through, what's available to me and what should I do.
Yep. So just a couple things to add. I mean, really, we've not done this topic before because there is so many different scenarios. That, again, is why our profession exists, is to work with people and work through this nuance. But we just thought it was a question that doesn't often get answered and frankly can't really even be answered if you do a Google search. I mean, certainly you can get help by doing that, but we just wanted to address it head on. We knew we weren't going to be able to do it perfectly because there's so many different ways we could go with it. So let's talk about a few more things that this is ignoring. This is ignoring any other assets that someone has, right? Because we're starting at zero with all of these scenarios. And what we will have the we should have the actual scenario up on the screen. It should make it a little easier for people to understand. But we're ignoring other assets. We're also assuming that spending never drops in retirement.
Important.
What we see often is that people retire. In our scenario, they retire at 60. We pulled that age out of thin air. But what we see often is, okay, from 60 to 70, people really want to have fun and spend their money. And then sometimes, quite often, spending goes down a little bit in those later years. Of course, we're also ignoring the other end of that. Sometimes medical expenses go up in the later years. So there are things that we just can't solve for in these scenarios. And that's important to know. We're assuming these people are robots and they spend the same amount every year. But that's an argument for going back to this is maintaining principle throughout life. Why do we do that? Because people aren't robots, and because we know that health expenses will go up at some point. So there are just some things we can't account for. So we always say we'd rather be vaguely right and have a picture of what it might look like than have no idea at all. So that's what we're really trying to do today. And really the last thing for me, and then I'm going to let you fill in and then get into your slides and your presentation here, is look, we hear often, oh, I'm behind. Well, the only day better to start than today is yesterday, right? So if you can't start yesterday, start today. And really, I mean, everyone feels a little bit behind. Not everyone starts their first IRA at 15 years old, right? Yeah. So there's some of that. Anything else to add there?
Two quick things I thought of. One is just remember looking at these projections. Like you said, they're a tool. We want to be vaguely right about the future. We can't be precisely right. And so part of the design of these tools is revisiting them every year. So, if markets are performing worse than expected, you don't just ride the plane into the ground, right? We will course correct along the way. The other thing I would say is I really would emphasize that Social Security piece. I know we do get a lot of people that say, hey, I don't want to include it in my projections. And if you have tons and tons of assets, maybe that's reasonable and maybe it's small relative to the size of your portfolio. But I will say, you can go back to our other video on it. The punchline is, hey, if nothing changes about Social Security, they don't raise taxes, they don't cut benefits, anything, probably about 75 to 80% of it's going to be there. And for some people, that can be $30,000, $40,000 a year. If there's two spouses, it can be $60,000 to $80,000 a year. So if you're saying, hey, I want to retire on $120,000 a year, we definitely see clients that think, oh my gosh, I need 4 times more assets than I have right now. But really, it's like, no, you need maybe 1.5 or 2 times. And assuming a worst case for Social Security, that can get you the rest of the way there. So that's the other thing I would say before you panic. Really look into Social Security, especially if you're planning somewhere between $70,000 to $150,000 in withdrawals. It could be a really big impact.
Absolutely. The scenarios we went through are very much almost worst case. In other words, they are, if you get no Social Security, and then a segue for you is that these scenarios are inflation adjusted, okay? Yes. And if we didn't inflation adjust the numbers, that your savings would be much lower. But that's the most important thing we can do. You need to inflation adjust your living expense.
Absolutely.
Because frankly, you can argue all you want about returns of the market and things of that nature, but we know that inflation has been around for a long time. It averages 2 to let's go. I'll give them a wide range, 2 to 3.5%. And frankly, we don't really see it going away. So it's important that we inflation adjust things and use those numbers. So
absolutely.
And there you go. That's a great segue.
Yeah, let's talk about it. So kind of to tee this off, inflation has been obviously all over the news lately. It's been historically high as it's been in 50 years. Last year it reached that point year over year. But even when inflation is not crazy high like it has been over the past couple of years, it's still just plugging away there in the background. And one thing that I see a lot with clients when they come in is kind of an oversensitivity to the risk of seeing their portfolio go up and down on a day-to-day, week-to-week, month-to-month basis, and undersensitivity to the idea that, hey, we've got to outpace inflation over 30 years. You compound 3% over 30 years. It's a big number. I mean, over probably double the amount of money you might need for a 3% inflation run over 30 years. And so that's really important to remember because there is a risk to being invested in stocks and that they typically are more volatile than bonds. But there's a risk to being invested in bonds in that they're going to reliably get eaten away by inflation much more than stocks have historically. And so that's what I wanted to show here. This is sort of a similar concept to what you were showing. It's a Monte Carlo graph here, and it's kind of showing that red line is sort of the 25th percentile outcome, which means, hey, 3/4 of the time you're going to do better than that. The blue line is the 50th percentile, which means that's kind of the average. The yellow line is the 10th percentile, which means 90% of the time you probably would do better than that. And if you'll notice on here, the difference between this one and the one you showed is I'm only looking at worst case outcomes here. So I'm looking at average and below because the question we get asked is about risk, right? It's like, are stocks too risky? And that's the point I want to make here. So this is a portfolio of just investing in really high quality short-term U.S. bonds. And kind of seeing, okay, if I take out $50,000 a year and I start with $1 million, what does that look like over a 30-year time horizon? And you can see that in the average scenario, you run out of money 2 years before the end. In the kind of below average scenario, you run out of money 6 years before the end. And in the really below average scenario, you run out of money, almost 8 years before the end. So, this would be not a very volatile portfolio in terms of your account balance, but you would be almost guaranteed to be in a bad situation down the line. It'd feel fine, for year 1 to 5, maybe year 5 to 10, but you would be so behind the 8 ball that it would be difficult to catch up, and you might end up going beyond the I want to bounce the last check. You might bounce the second to last check or even before that. So anyways, that's the kind of inflation impact on bonds.
I liked, just quickly, sorry, I liked what you said about risk. And I think that is one of the common themes that I see for someone that is less comfortable with investing, or maybe we should say less, has less exposure to investing. Yeah. Hey, I've heard that stocks are risky. Okay, they can be. Bonds can also be risky. Why? Well, because if you're outspending what you're earning. And what we need to do to maintain your principal, you have to out-earn what you spend. So defining all of the risks, which we don't have time for today, is one of the most important things we can do for somebody, is let them know there are risks to each decision you make. That's why we have to balance all of them, not just focus on one of them.
Absolutely. And it kind of brings me, I know the plane metaphor gets used a lot in investing, but the volatility, the looking at your statement balance change, to me that's like, and I'm a person who, I'm not afraid of flying, but I don't love flying. I don't love that sinking feeling when you hit a bunch of turbulence, right? That's the super visceral, oh my gosh, my statement balance changed, right? The inflation is more like the dangers of driving on a highway, right? You can look at the statistics and per mile traveled, way safer to be in a plane than a car. But I don't get the same feeling in a car of that sinking feeling that makes me think, oh my gosh, what's going on right now? And that's kind of the analogy I would use with, it's a really visible risk, the change in value of stocks day to day, week to week, month to month. But it's not more important than the other risks. And we have to look at them all. That's part of our job. But also as clients, that's one of the things that you can do to kind of keep those risks in perspective to be successful over the long term.
That's great.
So now we'll look at stocks. So you see, luckily in this scenario, the average scenario, you're actually generating wealth your entire lifetime, right? The below average scenario, you're not running out of money. And the very below average scenario, you are running out of money in year 19 instead of 22. So the worst case for 100% stocks for this hypothetical is about 3 years worse. The low case is much better. The average case is much, much better, right? And so this is starting to get into the idea that, hey, we're trading different types of risk here, right? Like, so maybe the absolute worst case with 100% stocks is worse than bonds, but at least on average, you're not going to run out of money. And then, going to the next slide here, this is really part of the magic of combining different types of assets and why our job is so fun, right? So a 70-30 portfolio has basically the same worst case as 100% bonds, but on the average, you still are generating capital over the long term, and the below average, you don't run out of money. And so, this is kind of the point, right? Is there's a different asset allocation that's going to make the most sense for everybody given their plan. We use tools like these to try to determine those. But in general, just keep in mind that, this portfolio on average with stocks in it, your statement balance would change more day to day, week to week. You'd see scary things in the news. Stocks would go down. A year later, they'd come back up like they have. that bond portfolio is going to be real steady, seem real stable and secure, but it's not necessarily going to give you the best results over the long term. So keeping in mind how big of a risk inflation is in portfolios, and that we have to counterbalance that inflation risk with the volatility of stocks.
Yeah, and that was going to be my piece to add after the last two slides. We're not, you and I really aren't even sitting here pitching stocks.
No.
What we're pitching is the right mix of different assets.
Yeah.
Right. And and again, kind of like what we started with, we said we're ignoring other assets. Well, that's how more complexity comes into the situation. What are the client's other assets? Do they have big real estate holdings? Do they have a business interest that is in oil and gas, it's in a certain industry? So those are the real nuances to this. And again, what we're pitching is what we are not even pitching, what we are supporting is a well thought out, well managed mix of assets, of stocks, bonds, and other assets. And you show that well here with the past 3 slides of, hey, if you're in totally bonds, that's a long way to fail. Yeah. If you're in totally stocks, maybe that's good, maybe that's not, but you're going to have more volatility. Can you put up with it? Well, if you get a good mix of those, we can kind of get a little bit of the best of both worlds.
Absolutely, yeah. So we're not pitching stocks, we're pitching, success for the client. We want to be as successful as possible.
Yeah.
So this last slide just shows, all 3 of those together. Again, just to reiterate, that first one's all bonds. You can see it, going down in all scenarios. The one right below it is stocks, which you see, hey, the bottom lines is up at the same place as the bond, but the other 2 lines are better. And then out to the right, you see kind of the best of both worlds portfolio, where we get the same worst case outcome as low risk bonds, but better kind of down market outcomes and better average market outcomes.
Okay, so 2 things that we can use to figure out how to get to that correct mix of stocks and bonds, Adam, are, right, how much are you spending and how far are you away from retirement?
Absolutely.
That's the last thing I wanted to add to this video, because we cannot tell somebody exactly what allocation they need. It's impossible for us because we don't know you, right? But how far away are you from retirement? How much are you spending? Why is that helpful? Well, number one, if you're 50 years away from retirement, you have a very long time horizon. If you're 2 years away from retirement, you may still have a long time horizon, longer than you think. It's depending on how much you're spending, right? And how long you're going to live, which, sorry, we don't know that. But I'm 2 years away from retirement. Well, if I'm going to live till I'm 90, or I know I want to pass on assets, maybe I do still have a long time horizon. Mm-hmm. So that's why we have to have the individual scenario. But those are the 2 things that can really help. How much do you want to spend? How long is your time horizon, right? Absolutely. We can go into 15 other different ways to massage that allocation, but those are 2 simple things that the viewer can take away and say, okay, maybe this will help me craft my allocation.
Absolutely. And to, just to extend the plane metaphor a little more, for me, it's kind of like, when you're at 30,000 feet and you hit turbulence, not a big deal, right? And that's like being 50 years out from retirement, 30 years out from retirement. As you come into land, turbulence is a really big deal. And they have all kinds of instrumentation at the airport to make sure you don't hit a weird wind vortex and all this kind of fancy stuff, because it really does matter. If you hit a big pocket of turbulence right before you land, it's something to be more concerned about. And so that's when we start, thinking a lot more seriously about the bond mix in the portfolio and things like that.
Yeah.
And another piece I would add too is, there's some people that just really, really, really hate flying, right? Mm-hmm. And at some point, do you hate flying enough to drive from New York to San Francisco? Right. Almost nobody hates flying that much. Mm-hmm. But some people, you fly in from Oklahoma City to Dallas or taking a car. Yeah, it's like,
take the bus.
I don't want to fly, right? And so there's a little bit of just personal, feelings and behavioral stuff in there too.
Yeah.
But yeah, all that stuff is stuff that, we can't give a rule of thumb that applies to everybody. It's really got to be conversation to understand their goals, their personality, everything else. I may be beating a dead horse at this point, but if they made it this far, maybe they want us to keep going.
Your analogy and the instruments that they have at the airport to make sure that you can actually land, right, is great, because that's often the best thing for someone to do, is not completely take all of the volatility, all of it out, but to manage it in such a way that you can still have the proper return without taking all volatility out, right? And without making yourself not be able to sleep at night. So all these plane analogies had me a little nervous. I'm flying later today. So that's pretty funny. I'll be thinking about this video at that point.
So yeah, so the last thing I wanted to cover here, we actually asked clients last year. This was in the middle of when inflation hit its absolute peak. We didn't know that, obviously, when we asked the question, but we were getting a lot of inbound questions. Inflation year over year at that point was 8%. Energy costs were sky high. It was wild. I mean, it was, almost pandemonium with inflation. 50-year highs, crazy. And so, we actually did a webinar on inflation. We asked clients, hey, what do you think inflation is going to be over the next year? And I had no idea what it was going to be, right? You had no idea what it was going to be. But I thought I'd bring that back up just to show how difficult it can be to make predictions in the moment, how different people predict totally different things. It's just really interesting. So if you look here on this slide, year-over-year inflation, like I said, last year was about 8%. The Fed actually asked consumers what they think inflation is going to be over the next year. And when they polled consumers last year, the average consumer said 5.7%. Our clients, it's not totally scientific because we asked within bands, but roughly I calculate our clients expected about 5.3% inflation over this year. And if you look to the right, I actually have a chart here. We had 12 people respond. 2 people said above 8. 1 person said 0 to 2%. 5 people said 5 to 8%. 4 people said 2 to 5%. So the other thing I'd point out here is it's really interesting because we talk to a lot of clients that will say things like everybody knows inflation is coming down. Everybody knows inflation is going to stay high. Everybody knows the recession is coming. Everybody, and just a reminder that we really do see one person come in adamantly believing something and thinking everybody else believes it in the morning, and then another person with a diametrically opposed view in the afternoon. And that's important, not just to say that we all should have humility about our predictions of the future, but also when we're buying and selling stocks and bonds, part of what creates the value of stocks is somebody else is willing to buy it, right? And so, if you, think that, inflation is going to be incredibly high, there's a recession coming, but half of the people out there don't, well, that's going to support the price of the stocks in your portfolio because there's going to be plenty of willing buyers that would take the other side of a doom and gloom bet, and everything on the flip side too. If you're, have super high aspirations for what's going to happen, maybe there's people out there that are a little more down on that, and that's going to keep stock prices and valuations more in check. So anyways, drum roll, 5-year break-even inflation last year, which is kind of what's priced in the market over 5 years, was about 2.5%, which, within that estimate probably was, hey, the first year is going to be really high, and then it would slowly come down. Actual year-over-year inflation was 3.3% going through June. That's lower than I would have guessed. If you asked me to guess last year, I would have guessed higher than that. A lot of that's from energy prices coming down. So, is that sustainable and predictable? There's further conversations we could have about that. But again, I would just say my favorite quote about, wasn't about investing, but is pretty applicable from Yogi Berra. It's tough to make predictions, especially about the future. And that is how I feel about a lot of this stuff. So the important thing we can do is look to data, look to history, use tools like the Monte Carlo, take our personal biases out of it, our personal feelings, think about the long-term, 10, 20, 30 years, investment horizons. Even if you're retired and you're 75, you don't want to plan that if you live to 83, you're going to be broke, right? And so most people have a longer time horizon than they realize. They need to be planning for the long term, not what's scary and in the headlines right now. I just thought this inflation thing was a great example of something that absolutely surprised me. I'll probably be surprised again in a year. And the point is not that, hey, we should get better at predicting inflation on a year-over-year basis and trade on that. It's that, hey, this is really, really hard to do. Professionals mess it up all the time, and a long-term investment plan shouldn't be impacted by the noise of what's going to happen next month, 6 months from now, a year from now.
Absolutely. That's great. And, I think this whole video, again, if they made it this far, it's to inform and to try to arm people with tools that can help them get to the right place. Ignoring inflation is a terrible idea when making an investment plan.
100%.
And I liked your point here that good investment plans aren't based on economic predictions, right? They're based on you, and they're based on your goals. So again, that's what all of these videos are for. We're trying to inform, but also educate and empower people that we don't work with to do these things on their own. So just want to say thanks everyone for watching. Thanks for being here with us. we enjoy doing these, and we're always accepting feedback. We've gotten some great feedback and also gotten some great topics from people that have watched and say, hey, I'd love you to cover this. We always invite you to let us know if there's something you'd like us to hit, to dig into. We can go high level, kind of like we did at the start today, or we can go very deep and get into some nitty gritty. So if there's anything that you all would like to hear us visit and dig into in the future, just let us know. We're glad to do it, glad to be here. So thanks a lot.